7.5%. Today government borrowing has touched 9%. And now with that, a small SME sector definitely 11-12%. Some of my kids, my FMB colleagues, students or kids, I call them kids, right? They are borrowing at 14%, 14.25%, right? Full gone.
What will be the situation of real estate?
Real estate, sir, I personally believe that it depends on which, right? If you're looking at a smaller developer, there'll be correction. But if you're looking at a bigger developers, a lot of PE and VC funding has gone into their projects. So they are sitting on funds. So they will not try to correct the prices. But a smaller guy who does not have access to a private equity or a VC, he will try to liquidate his stock. So it depends on one, location, second, the developer. So you would possibly see a 10 to 15% correction from the smaller guys. Bigger guys, maybe 5 to 10%, not more than that. They've got a lot of funding from private equity, sir. Right. Private equity money. Private equity money coming in has helped them hold down. See, so private equity is foreign guys coming in and pumping in money because real estate India good. So now they don't need the cash flow from the buyer. They have got the cash flows coming. But the point will come when the PE, VC guys start for asking for returns. Then we need to watch what is happening. But uske liye abhi thoda time hai. As of now, right? As of now, what the bigger developers are saying is, we are okay with the conditions. Smaller developers, if you're talking of real estate, smaller guys, you may see a 10-15%. And also location-wise, sir. You'll have to go back and see location-wise. Some parts of Mumbai and all have taken off. Hyderabad, right, we know. Bangalore has. So there, some pockets you will see a deeper correction. I wanted to stress on ECB. Thank you for that. Let's start with a two-stage growth model, with your permission. Just have a look at it. Let's discuss. Right? Let's talk and discuss. I'll just pull it up. We can discuss it. This model is for you all. Please, so there's no problem. Right? Where I can't share, I'll tell you I can't share. That I have just disclosed here is the assumption sheet. Okay, I think it's clear for all of us. This is your base year projections. This is your base year projections. This is where you are today. Okay, just feed in your number. So just feed in your numbers. First sheet I put as assumptions. Second I put as calculations. Okay, so your current is about 4,000, right? EBIT current ratio is about 12.5, right? We have discussed what is EBIT. Earnings before interest and tax, that's about 12.5% of 4,000. That's 500. Proposed capex is about 300. I need you to input. I'll put it whatever I need you all to input. This I need you all to input. This I need you all to input. Depreciation amortization 200. Again, and this I want you all to input from your past. I'll just finish and then ask you all any questions. Working capital as a percentage. So you will go back. Thank you for making me repeat what's working capital to your balance sheet. And since we are having all existing companies here, there's no question of projections. Just go back, look at your balance sheet, get this figure out. 30%. Corporate tax, please note, this is what I clearly wanted to say, effective corporate tax. I've taken it as 40% because I wanted to link it up to the sheet. Please put down your value, right? And as Sir said, it is effective corporate tax. Paid up capital is about, right, 300. Sir did talk about net worth, right? This is that net worth, right? I'm taking a face value of 10. This I want you all to input. And market value, there is no question of market value here. Since it is unlisted, most of us have unlisted debt. So just take your balance sheet figure. It comes to 1250. Any questions on this? Except for this, all others to be inputted, right? Any questions on the basic data? Any questions on the basic data? Yes, sir. Boliye na. Vishwaji, you were saying something. Yeah, please.
The EBIT percentage
is from your past details.
Should be average or what?
Nice questions. Very nice questions. Either you take an average. I would prefer you not taking an average and just taking your past, just the recent past, last year. But acha question hai, sir. If, right, one sec, right, please note, sir, in case you say the past is an exception and out of the last 5 years, 1 year is an exception, knock it off. The other 4, you can take an average. Please don't take simple average. Please take weighted average and give higher weights to the recent years. So when you take average also, just give weight. So let us say you give a weight of 3 years लेते हो, तो एक को आप weight 3 दीजिए, दूसरे को 2 दीजिए, 1 दीजिए, divided by 6, and then arrive at this, right? Good question. My request is, if your last year has been representative enough, just take, like Sanjay sir, I think with a 4-year-old firm, he should take the last year's figures. It's as simple as that. No projection at this point of time. This is a base year calculation. This is a base year calculation. Please watch, right? This is clearly a base year calculation. So you're saying something?
So even the second row, we have to EBIT also we have to input, right?
Yes. No, you don't have to input this. This number is what you want to input. This one, right? Yes, sir is right. You have to input EBIT. He's got it, but not this number. This number. Inputs for high growth rate. Now we'll start discussing. अभी काफी discussion होगा. I repeat, I have given you a hard copy. I have no problem sharing this. If you got a pen drive, take it now. Absolutely. But understand what we are doing, right? Many people don't like to share this. I am more than keen to share this with you all. But understand, what should be the length of growth rate? I have taken 5 years. Pillai sir, does it matter? Length of growth period. Does it matter? Why does it matter, sir?
Depending on more the number of years, you have a challenge to understand. More the number of years, the better.
So 5 years, you could say 7 years, 10 years?
But as we've already said, it will not make many material difference. The terminal value gives the 60 to 70% of the value. So whether you take 5 or 7 or 4, it's not really make any difference.
And second, thank you, sir. In fact, but coming from Mr. Pillai, right, I know he would be at something. Please also note, if you're going to project more than 5 years today, people will take it with tons of salt. I'm not even saying pinch of salt, I'll say tons of salt. We don't know what's going to happen tomorrow. Are we talking about projecting for 10 years? There was a time where we used to project for 10 years, immaterial. Absolutely immaterial, because I'm so happy you all said it. Thank you very much. This really doesn't matter. What matters is this columns here, the terminal value calculation. So you can take 5. Your industry, I would suggest, especially the colleagues which are into obsolescence and industries, manufacturing safely you can take 5. In fact, I don't think beyond 5 it will make a lot of sense. Anybody who is in an obsolescence industry where it turns fast, not you, sir, then for you all, I think even 3 years is good enough. For you, sir, safely you can take 5 years, absolutely 5 years. What is the growth assumed here? The growth I have assumed is about 10%. This is on the lower side. When I want you all to go back, I want you all to go back and talk to yourself. You all should talk to yourself and say, excuse me, what will be the expected growth rate over the next, 5 years, right? Over the next 5 years, how does it go across? Then you would find that this figure will no longer be 10. I would suggest, right, input, I'll put the comments here, input as per projections. But if you are going to say something like 30%, 40%, remember that that has to continue for 5 years. And that's pretty difficult. So this number here, you should input in such a way that that growth is year on year over 5 years. Working capital as a percentage of revenue, again from balance sheet, this we have picked it up from here, right? So again I put it as 30%. This actually I picked it up from here. What if you are acquiring any company? What should this figure be? What if you are acquiring any company? What does this figure should be? Sir? Post-merger, how much should it be? I'm not.
You should take the. I mean, if you are more mature than.
I think I have not communicated. You have to answer, so you got the answer, but I have not communicated. Some dear colleagues are keeping quiet. I am saying this is your base case where this is the target company. My question is, I am acquiring Mrs. Sanjay's restaurant. What is the case? And I am acquiring it. I am going to run it. What should be the case for working capital as a revenue percentage?
I am more mature, I will take my working capital percentage and apply it to the acquiring.
Thank you very much. Here, this 30% you should factor in. I'm giving you a model for M&A. Some of you all are from M&A. Please factor in synergies. Thank you very much. Thank you. Thank you. Value the company. I hope I've simplified it. I told sir I'm going to tie up everything now. Value the company from the buyer's perspective. Sanjay sir, I got 30%, Prasanna sir. When you take over my company, when you take over a German company, maybe you will be able to do it much better. Why 30% of revenues? You were able to run the unit, Mr. Saraf, sir, at about 25% of revenues. Please put that account. Please put that here. This should factor in synergies. Here, I am just giving you a model. I told you right at the beginning. I am going to give you a model so that you know the workings. But इसमें क्या input करना है is where the challenge is, where you will have to sit back and talk to your team.
What percentage you want?
Please, sir. Please.
What percentage you want? It depends on which side of the table you are. And if you are acquiring a company, you can provide a value to them and it can go down. But you use them, you want your valuation, your percentage which is the higher, they will not accept it. No point in doing that.
Very true, very true. But the point is, sir, if they are more efficient in terms of working capital, then the fact of the matter is, very nice point. It's better to have their ratio going to understand what's the maximum value that you can pay for the business.
How do we factor in this? Identification of synergies and then quantifying it. That I feel is something that is very challenging.
You should. I'll tell you, your questions have been very apt, very practical. Before I give it, I think I should politely request. Sir, yeah, go ahead, please.
We faced a similar situation. Yeah. We almost went for the deal, and we were about to sign the papers, and they threw something. So this happened recent past. So when we factored synergies, the M&A team, the corporate finance team, came out with the valuation, but they went a full circle. But they had to come back and start and talk to marketing. They have to. And quantification of the synergies, right? The revenue synergies and the cost synergies that had to come from the operation from us, and which is typically a delivery. Right. So 3 people had to sit and brainstorm for a week to bring in the synergy value projected for 5 years, for the next 5 years, what can be realized. Okay. And then when we went, we had a totally new valuation which they didn't agree. We were saved finally. So. Okay, so if we are not taking this factoring the synergy thing, we are definitely.
Thank you. Specifically, I think a operations guy should be involved. The marketing gentleman should be involved. I would also request you to also involve the HR colleague. Because the HR colleague, because most of the time we'll go across with a cost-cutting scenario. And the HR colleague will actually tell you, come back and tell you, excuse me, though you are thinking of cost-cutting and you're saying you're going to increase EBIT values, I don't think you can do that in this particular scenario, because in this particular domain you can't do it. The quantification should be at the last stage. So you need to have, and it's very well done in Godrej. I need to praise some units here. Godrej is very clear. They'll actually identify the target. They'll ask each of the department heads, or will come back and in the matrix organization, they'll come back and say, tell me what benefits do you see in this. Then it is coming to the side to the finance guy to quantify it. Absolutely. And the finance guy will be the last stage in quantifying it, but the inputs have to come from the department heads. Some are very nice questions, very nice responses also. I question too, I want to repeat. Please note, in some organizations, which I don't want to say publicly, we find that valuation itself becomes an Excel exercise.
Excel exercise mainly reviews to finance department.
It has to come through. It has to come through strategy. Finance is the last thing to understand, where do you pitch in at. But the finance guy has to be there at every step, but inputs have to come from the strategists.
The problem with finance is we get the cost synergies very efficient. Very efficient. But the revenue synergies will have to come from the people who are delivering it. At least who are selling the brand. So at least selling and marketing.
Thank you, colleagues. Here is it.
Yes,
Sorry, I didn't see that.
Synergies is a much talked about, it's a much abused word. We talk about it's happening, but in reality, it happens much less. So you can take in the benefits of synergy, can see the potential upside of that valuation. But I think when you really want to value a company, see without any synergy on a standalone basis, doesn't make a sense. If it does make sense, but it's making sense on a synergy basis, and you go ahead on that decision, it might backfire.
Surya, can I just add something here and possibly request you to just tweak a bit? right? Don't value it as a very nice point, but I just as humble value add for you, sir. Don't look at it at a standalone basis, sir. Do it the other way around. Do it synergy, right? So you may accept or decline it, but I'll tell you the way I do it. I build in synergies. I look at it with the synergy. Then what I do is what is known as sensitivity analysis. So what I do is the critical parameters, I'm going with the flow. I wanted to say sensitivity towards